Welcome to the Explainer. Today, we are putting Uniti Group through the ultimate valuation gauntlet. We're going to see exactly how legendary investing frameworks apply to a highly leveraged, real-world company operating right now. We'll take the raw data from their latest financial reports and run it through the rigorous lenses of some of the greatest investors in history.
Here is our roadmap for today. We'll start with a quick snapshot of the company, and then we're going to stress test this stock against the legendary minds of Warren Buffett, Peter Lynch, and Benjamin Graham, before finally running it through some modern discounted cash flow modeling.
Part 1. Uniti Group, Company Snapshot.
So what does Uniti actually do? Well, their business relies on a mission-critical physical footprint. They are a massive digital infrastructure provider that was actually born from a recent transformative merger with Windstream. They own approximately 240,000 fiber route miles stretching across 47 states, reaching about 1.9 million fiber-equipped households. They are literally laying the physical groundwork for our digital economy, catching the massive surging demand from hyperscalers and generative AI.
But to really understand this stock, we have to look at the math. Here's the baseline data straight from their Q1 2026 earnings report. The ticker is UNIT, currently trading at $11.49 a share. They've got about 252.1 million shares outstanding, but you absolutely need to notice that bottom number, $10.6 billion in total debt. That is a staggering figure, and honestly, it's going to be the central character in our analysis today.
Let's move to Part 2, the Warren Buffett lens.
You probably know the Oracle of Omaha's philosophy. He loves a business with a deep, protective economic moat. But he also demands pristine financials, high returns on equity, and a crystal-clear margin of safety, especially when it comes to debt.
And this is where we run into a really stark contrast. It's like looking at two completely different companies. On one hand, Uniti has an undeniable physical infrastructure moat. Think about it. It's incredibly hard for a competitor to just wake up and overbuild 240,000 miles of fiber. But on the flip side, the financials are deeply troubled. They posted a net loss of $70.3 million in Q1 2026 alone. Because of an accumulated deficit of nearly $2.5 billion, their return on equity is actually negative. And of course, there's that massive debt load we just talked about.
So, let's grade them out using Buffett's criteria. Economic moat, pass. Honest management, pass. They have a new insurgent post-merger leadership team that's aggressively targeting growth. But consistent earnings, fail. High return on equity, fail. Manageable debt, that is an absolute fail. If we try to calculate approximate owner earnings, it's deeply negative right now because they have over $1.4 billion in heavy capital expenditures just dragging down their cash flow. So Buffett's strict checklist triggers a hard pass here. To even consider this, he would demand a significantly lower price or some kind of total debt restructuring just to secure an adequate margin of safety.
Let's shift gears to Part 3, the Peter Lynch lens.
Now, Peter Lynch had a slightly different vibe. He didn't just look at debt in a vacuum. He looked at the whole narrative. His very first step was always to categorize the company, trying to find the hidden value tucked away in its specific situation. Applying Lynch's framework, Uniti is your classic asset play, and maybe a potential turnaround. Now, his absolute favorite metric, the PEG ratio, is actually non-applicable here because the negative earnings completely break the math. But Lynch would be super intrigued by their stated catalyst. Management has identified between $500 million and $1 billion in non-core assets, things like excess fiber and real estate, that they plan to potentially monetize over the next 12 to 36 months. For Lynch, that hidden asset value makes this a cautious hold, especially if we start seeing insider buying that signals confidence in the turnaround, combined with their currently low institutional ownership.
Next up, Part 4, the Benjamin Graham lens.
Ben Graham, the absolute father of value investing, is all about the margin of safety. He demands positive numbers, earning stability, and a fortress-like financial condition. There's zero room for hopeful narratives here. It is purely about what the balance sheet can prove to him today.
But here is where we hit a massive brick wall with classic value formulas when we apply them to highly leveraged infrastructure companies. When we try to use Graham's famous intrinsic value formula, the math completely falls apart.
See, in Q1 2026, Uniti reported a basic EPS of negative 34 cents. And since you literally cannot find the square root of a negative number, Graham's formula just collapses. From his perspective, the intrinsic value is exactly $0.00. The debt is way too high, the earnings are negative, and the margin of safety is totally non-existent. Graham wouldn't touch this stock at any price.
Let's pivot to Part 5, DCF and Alternative Valuations.
Since the old-school gurus gave us a pretty mixed bag, let's build a modern, forward-looking discounted cash flow model, or DCF. We run into an immediate issue, though. Free cash flow is currently negative because of that massive $1.4 billion capital expenditure guidance. To make the model work, we have to assume their heavy capex normalizes and drops significantly by year 4, right as the initial fiber-to-the-home build-out matures. If we discount those future flows back at a 9% weighted average cost of capital and tack on a 2% terminal growth rate, we generate a theoretical fair value that hovers right around the current market price of $11.49. But be warned, running a sensitivity table on this shows that if that WAC ticks up even slightly or terminal growth drops, the fair value absolutely plummets.
We can also look at alternative models, like comparable company analysis. If we take Uniti's enterprise value of roughly $12.4 billion, which factors in all that massive debt, and we divide it by their guided adjusted EBITDA of $1.45 billion, we get an EV to EBITDA multiple of about 8.5x. In the telecom and digital infrastructure space, 8.5x is perfectly standard. It strongly suggests the stock is currently fairly valued relative to its peers.
And Wall Street analysts largely agree with this assessment. Based on recent data, the consensus average price target is $10.25, which is actually slightly below the current trading price. The targets range from a low of $6 an ounce to a high of $16 an ounce, perfectly reflecting that brutal tug of war between their incredible asset potential and their crushing debt burden.
Finally, Part 6, Synthesis and Final Verdict.
Let's bring all these wildly conflicting signals together. Buffett says avoid it, largely due to the debt and lack of consistent profits. Graham gives it a hard no, anchoring his fair value at 0 because the intrinsic value math breaks on those negative earnings. Lynch gives it a hold, banking on the potential turnaround and hidden asset monetization, and modern DCF and multiple models also suggest a hold, showing the company is trading right at fair value for its industry. Ultimately, while those physical fiber assets are incredibly valuable and perfectly positioned for the AI boom, that massive $10.6 billion debt burden forces a final synthesis of a cautious, watchful hold at its current price.
So I'm going to leave you with this final thought to ponder. Uniti is a fascinating race against time. On one side, you have an unstoppable force, the explosive, undeniable demand for fiber to power AI and hyperscalers. But on the other side, you have an immovable object, a $10.6 billion mountain of debt. Watching which side actually wins is going to be the ultimate lesson in market mechanics. Thanks so much for joining me on this explainer, and keep learning.